Yes, we're doing a special feature today on commodities, and particularly two areas, the oil market and industrial metals related to battery technology. For that purpose, I have invited two experts on the subject. It is Nitesh Shah and James Butterfield, both from ETF Securities, flying in from London, I guess, to meet clients and just spread the word about ETF Securities. So first question, what is ETF Securities?
ETF Securities it's an ETF firm, essentially, where we have exchange-traded commodities, exchange-traded currencies, exchange-traded notes, and exchange-traded funds. It's essentially the ethos of the firm is about providing access primarily to commodities to investors. When the firm started, we created one of the world's first gold ETFs. As an investor, it was very difficult to invest in gold. You would have to arrange physical delivery, maybe, arrange insurance, arrange storage. It was a very impractical thing. Essentially, what our firm did was create a very simple way to buy gold, but without all the headache of storing it and insuring it, etc.
Okay. And what about you guys? What is your role at ETF Securities?
I'm head of research at ETF Securities. I've been here 2 years. Previously, I was a fund manager. And I suppose my role and our roles are really to help educate clients and understand the commodity space and equity space better, really.
Yeah. And you, Nitesh? Yeah.
So I work on commodity research within the research team. So I help investors understand what are the fundamentals driving everything from gold to coffee to sugar to oil. So that's my role.
Yes. And today, about oil.
Yep.
You have held a presentation earlier on today, and it was very interesting. And for that reason, I would like to have you telling our audience about the oil market. You had an interesting projection there, for instance. But first question is the whole trend with the price and so on, very much related to two different things, OPEC and the US production, I guess. Can you give a short background on, for instance, the OPEC, their strategy and what they're aiming for?
Sure, yeah. I think it's very important to understand today's world in the context we've come from. So prior to 2014, oil prices were trading very high. And in the environment, a number of countries were able to expand their production. For example, the US in the past 7 years has been able to expand its production and reversed almost 4 decades of production decline. So looking at this chart over here, you can see that there's been very strong increase in production from the US. But around 2014, OPEC, the pricing cartel, was unhappy with them losing market share to what they thought were high-cost producing countries. And they sought to increase their own production and bring down the price of oil. While OPEC was very successful in bringing down the price of oil, it wasn't so successful in actually taking away the market share from countries like the US. So bringing down the price, they were very successful. As you can see from this chart, in 2014 to 2016, prices collapsed from just over $100 a barrel to just below $30 a barrel. But that damaged OPEC's own financing substantially as well. OPEC countries are highly reliant on oil revenues to fund their government spending. And they couldn't tolerate this reduction in revenue for so long. So looking at this chart over here, you can see just how substantial the fall in revenue was for OPEC countries. So in 2016, OPEC decided to change strategy once again back towards price stabilization. Here again, they haven't had a huge amount of success because during that period of weakening prices, what used to be higher cost producers like the US were able to reform, and we were able to bring down their own costs quite substantially. So looking at this chart over here, in the US, US operators that used to be able to break even at prices above $80 a barrel back in 2014 are now able to break even around $50 a barrel for oil, and therefore can continue to increase the production of oil. So therefore, oil prices are range trading between $40 and $60 a barrel in this current environment as the US continues to increase output. And that's really undermined OPEC's strategy to actually increase oil prices post 2016.
Yeah, so it's the strategy on it's a failure to be in clear terms, isn't it?
Yes, it is. And one of OPEC's problems has always been, although they set about quotas to limit production and therefore proper prices, they're very poor at adhering to those quotas. So just looking at a chart here, so this is before the price war started in 2014. The green line is their actual production, whereas the black line is the quota that they've set themselves. More often than not, they've been very poor at actually adhering to the quota, producing less than the quota amount. And looking at the deal that's just emerged at the beginning of this year, looking at individual countries, the compliance with the deal has been very patchy. So while you have some countries like Saudi Arabia who are adhering pretty strongly to the program, you have other countries like Iran and Ecuador who aren't meeting their obligations of cutting back substantially enough. So OPEC is failing.
It is failing, yeah. Compliance has been very poor. Do you see trends shifting again, that it will be more compliant to this deal that they have struck, or what will happen?
Yeah, so I think compliance will remain quite poor. And the OPEC group of countries are due to meet next month at a policy meeting to decide what's going to happen forward. So their current deal expires in March of 2018. My expectation is that OPEC will roll forward their current program to the rest of 2018, but they aren't going to make the necessary step to cut deeper. And I think that's what they need to make oil prices break out of the current trading range of $45 to $60 a barrel. So in the absence of that, I see oil prices continue to range trade around between $45 and $60 a barrel. The lower end of $45 a barrel is largely set by the break-even cost for oil in the US. Whereas the upper bound of that range, $60 a barrel, I think that's the realistic price that OPEC can push prices up to. Its largest component, Saudi Arabia, would like to see prices higher than $60 a barrel because it wants to sell part of its state oil company next year and requires a strong price to maintain the $2 trillion valuation that it's publicly announced. But realistically, its ability to convince other OPEC members to do more is going to be constraining, and I think $60 a barrel is going to be the limit that it could reach. Yeah,
and looking at the US, what will happen with the production over there?
Yeah, so the US, I think, will continue to expand. Now, there's two major areas of growth that we've seen in US production. One is in the Permian region.
And where is that?
That's in Texas. So I can show you a chart, a diagram over here. So the Permian region, the brown region over there, is one of the largest shale producing regions.
Yeah, by far, I would say it is. It's far higher production there than anywhere else on the shale.
That's right, and it's grown substantially just in the last few years as well. So 3 years ago it wasn't the largest, but now it is by far, and we're likely to see a lot of growth within that shale producing region and in the Gulf of Mexico, which is offshore oil production in the US. The two major areas of production increase, I would say, would be the Permian region, the green lines over here, and the Gulf of Mexico, the grayish, dark grey areas over here. Permian is shale oil production, Gulf of Mexico is offshore oil production. So the Permian region, we expect continuous growth in production. There's been substantial gains in efficiency in production from the Permian region. And the nimble shale market in the US will continue to attract the funding it requires to expand production, and indeed the technological deployment in that region is likely to continue. But when it comes to the Gulf of Mexico, which accounts for about 15% of total US production, right now for the next 2 years we are going to see growth in production, but beyond that I think growth will start to slow down. Right now we're seeing the growth in the shadow of capital expenditure made by oil companies made several years ago. But in this environment of relatively weak range-bound prices between $40 and $60 a barrel, we are going to see the next wave of investment that will help unlock further oil supply. And here I'll show you a chart which demonstrates how new investment would require substantially higher prices that we're unlikely to see in the next few years. So it's going to be a tale of almost two areas. Shale will continue to expand very strongly, but in the Gulf of Mexico we should start to see growth slow down after the next 2 years. But going into the sort of the medium to longer term, looking at demand in the year 2020 to satisfy the demand that we're going to see out in the future, we will need to see more oil coming from supplies that aren't currently producing right now, and that will be at much substantially higher break-even costs. As what we're seeing right now is to get the last barrel of oil out the ground in the future, we'll see more competition for some of the inputs for bringing the oil out the ground, including sand, the fluids that are pumped into the ground to fracture the oil. And that will require a break-even cost of around $60 a barrel at least to bring out the higher cost shale. So over the medium term, going beyond sort of 2020, we are going to see oil prices pierce the current range.
Interesting. Thank you very much for that, Tash. I think should we look into the other area that we were aiming for today? It's industrial metals related to battery technology. And I know you, James, is a bit of an expert in that area. So first of all, lithium is like a hype around that metal. Can you explain why?
We get a lot of questions from clients about lithium at the moment. Will we create a lithium ETF? The reality is it's probably a few years yet because there's no functioning futures exchange, which makes you can't really create an ETF or an ETN, for instance, if that doesn't exist. Lithium, I suppose, has been hyped up due to so much talk about electric vehicles. I think Tesla has been very good in its social marketing campaigns, so therefore there's a lot of awareness about it. And also in terms of the environment and people's concerns over that. And then again, from an investor perspective, investors are looking at oil and thinking, well, is there really a future in oil? And what would be the next energy metal, for instance? And maybe that's lithium. So investors are thinking, maybe I need to hedge my risk in my oil positioning by owning some lithium. So what I suppose I could do is spend a little bit of time just talking about lithium.
Yeah, please, because as you said, it's a bit of a hype, and but at the same time, not a commodity that you can actually trade. It's not on any exchange. No. So I know that people have been invested in like mining companies. Is that a good idea if you want to have exposure to lithium?
From our analysis, probably not. We've got a slide here to try and demonstrate that. This slide is really showing you that if you look at the Selective Lithium Index, that is a group of mining companies who mine lithium. It doesn't seem to correlate to the lithium carbonate price. That's the green line there. It actually is much more closely correlated to crude oil. Ultimately, these mining companies are involved in many different mining projects, and they're quite energy intensive, and that's why miners tend to be correlated to the oil price to some extent. So if investors really are looking for a hedge against oil, actually perhaps lithium equities aren't the right choice.
So if you want an exposure on this, because it is it's a technology for the future, not only electric cars, it's storage and so on, general storage for energy. What is the best strategy, you think?
Yeah, if you can, I'll just switch to a slide on lithium demand by sector. The biggest growth here you can see is in electric vehicles and energy storage. They're the two areas there that are really growing right now. And so somehow you've got to play that. Lithium as a metal isn't really investable at the moment. In fact, what's happening is many battery producers at the moment there's no exchange, so they're going straight to the lithium producers and doing deals directly, which is actually quite an old-fashioned thing. The London Metal Exchange was created to counteract that kind of problem and create some sort of price transparency. It's why it's actually very difficult to find a lithium price right now, because the prices are done at different deals, different prices all the time. Ultimately, though, we know electric vehicle usage is going to be very prolific. And there are some interesting side effects of increased electric vehicle usage. Mainly, the average internal combustion engine car uses about 20 kilograms of copper, whereas the average electric vehicle uses about 80 kilograms of copper. So a lot more copper usage. And probably by 2035, we'd see about 15% of copper demand is probably for electric vehicles. And our view is that's on the conservative side. If you look at how many cars can be charged in any given road at the moment, it's about 6 cars. And after that, you tend to get what's called localized brownouts, sort of localized power cuts. It's because the grid can't take that additional power consumption. So there will need to be upgrades to electrical grids to really charge more cars on any given road. The problem with that is that requires an awful lot of infrastructure spend, and infrastructure projects take decades. And that's perhaps why many government projections on how many cars will be in production or how many electric cars will be on the road is perhaps a little bit unrealistic. But therein lies an opportunity. Those companies that are upgrading electrical networks, again, copper will probably be used in that respect too. There are some quite unusual offshoots in terms of demand for copper. If you look at the composition of a lithium battery, for instance, you see a typical lithium battery, only about 16% of it is lithium. There are other components that are very important. So in your mobile phones, for instance, cobalt is used in the lithium cobalt batteries. In the electric vehicles that, say, Tesla uses, their nickel is used a lot, and then also manganese. And these metals do trade on the London Metal Exchange, but they're quite illiquid. And they're also very volatile, and they have a few problems politically, particularly something like cobalt, which the majority of it is mined in the Congo. Some other unusual metals are dysprosium, for instance, which is used for the magnets in electric motors, for instance.
Okay. Yeah, you mentioned Tesla, and of course they're very much driving this market forward. What about Tesla itself? Is it a success also in the future?
What are the prospects for Tesla? Well, it's not making any money yet. It has a large, very efficient automated factory system, but it's having problems. It's not being able to deliver a lot of the cars it promised. And the big supply chain constriction is in the batteries. It's actually battery production that's slowing it down rather than lithium. We don't actually think that there will be a supply problem with lithium in the coming few years. So prices are unlikely to rise to the lofty levels that some people expect. But this does pose a challenge for Tesla. At the same time, there are many other car producers such as Volvo and BMW that are taking electric vehicle consumption very seriously. It is upsetting for their businesses, though, because most existing car companies' sales models are based on after-sales care, and that's where the margins are. And so they're really having to reshape their businesses too. But as larger producers start to really get in on making electric vehicles, I think this does threaten Tesla. I think Tesla will ultimately remain a niche car builder that's targeting the top end of the car market. The average car price, the current car price, is $24,000. For an electric vehicle, the cheapest is $33,000. You've got to get electric vehicles down to that $24,000 mark for them to be, I think, really bought en masse by many people, and also upgrade many electrical networks too.
Yeah, but you don't think Tesla will take that path?
No, I think they'll probably remain in that sort of niche area. They have the Model 3 is a kind of response to that to some extent, but they need to come out with a cheaper model, and I do expect many new electric vehicle models, all the signs are from bigger manufacturers that they will be much closer towards that $24,000 price range.
And also the prices of batteries and so on must come down further. And you do expect that? Or?
Yeah, the average price for per kilowatt hour of a battery is about $350. The average price for an internal combustion engine is about $150 per kilowatt hour. So it's got a long way to go, I think, to match the internal combustion engine, where also efficiency is increasing all the time. So it will continue to compete with electric vehicle usage.
Okay. So to summarize, still, if you want to be exposed to this trend, lithium perhaps, but not perhaps the best idea. Copper, perhaps a better idea? Or?
Yeah, lithium isn't really investable at the moment, rather frustratingly, I think, for many. It would be a great diversifier in a portfolio. It's quite uncorrelated to other commodities in that respect, but we're not there yet.
No.
But one of the interesting offshoots is the big pickup in copper demand as a consequence of rising electric vehicle usage.
And precious metals, silver, for instance, is also used in battery technology?
It is to some extent. I think silver is probably more closely linked to gold as a precious metal, but there is a large industrial usage as well. And as we believe global growth is likely to remain elevated in the coming few years, silver is likely to benefit from that, but probably, I think, less so than, say, copper is in terms of the electric vehicle market.
Okay. All right. Thank you very much. I think that concludes today's program, and very much thank you for listening to us.
Thank you.
Right.